Now this is going to come up in your homework, so pay attention to this one. You've got a few non-operating assets in that balance sheet, and you're going to have to value them correctly in the last step, which is adding the non-operating assets to the DCF operating value to calculate your enterprise value. So both of these things that we're going to be talking about in this lecture, you're going to need to do and follow pretty closely for the final homework. Okay, so we've got to look at all our non-operating assets, and we've got to analyze them and value them correctly to add them up and get our enterprise value. The next part of that formula is going from enterprise value to equity value. And in order to do that, we need to deduct the value of any claim, any non-equity claim on the firm. And that just means anything that the firm owes to anyone needs to be deducted before we calculate what's left, which is equity value. So the most common things that are owed are debt, right? The firm might have bank loans, it might have bonds, but it could also be debt equivalents, and this is anything that looks and talks and sounds like debt, but isn't called debt outright. So this could be operating leases, which we've talked about some, any kind of rental agreement. To me, any kind of like contracted payment is like debt, even though it's not called debt. A rental contract is just like a loan. It's just not called a loan, and you don't end up owning it afterwards. Any kinds of more unusual debt equivalents, we haven't talked about things like securitized receivables. We have talked about things like pension liabilities. So this is something that the firm owes its employees, right? Anything that the firm owes. And then there's hybrid claims. Again, we're not going to spend a lot of time going into detail here because I don't know what kind of level of investments everybody's taken, whether you guys have all taken derivatives or anything like that. But hybrid claims like convertible debt or preferred shares or employee stock options, which is part of compensation, any kind of non-controlling interest in the firm, which is somebody owning a stake in us. All of this stuff is owed to somebody other than the owners, right? And so they have a claim on the firm's value. And that claim needs to be valued and deducted before we can estimate the equity value, what the firm's owners actually own. And that's the last step. So we'll talk a bunch about, just as with non-operating assets, we'll look at the most common types of non-equity claims, and we'll talk about how to value them, how to account for them, how do we incorporate them into our model. Again, the final step then is take equity value, divide by the number of shares, get equity price. Right? So we'll start by going into a little more detail here of our non-operating assets. What are the most common ones? And particularly, how do we value those ones? And what I've tried to do and throughout the slides is list the common operating and non-operating asset or the common non-equity claim, and then highlight how to value them. Okay? So if you see any of these things show up in your homework or show up in a valuation project that you're doing for another class, you can come back here to these slides and look for that item, and then come and look at the highlighted part, and that's how you should estimate the value. So for instance, this top one says excess cash and marketable securities. Now, we've talked about excess cash, and obviously you guys solved for it in the fourth homework. And what excess cash is usually used for in these models is a plug. It's a plug that helps to balance the balance sheet in our forecasted years. But it doesn't always look like that because lots of firms hold excess cash outside of our forecasts, right? Apple has $200 billion in cash. Surely the vast majority of that cash is not needed for operations. It's excess already. So they are going to have that excess cash invested. By law, you can only call it cash if it's invested, either kept as a savings account in cash or invested in what are called marketable securities, which are typically, there's a small short list of what are allowed to be marketable securities, but basically it means they've got them in like US Treasury bonds. So they're earning some interest rate because it would be silly not to have $200 billion earning some interest. And that's why excess cash is tied to the interest income item on the income statement, because you're assuming that they're not just letting that cash sit and languish in some savings account earning nothing. It's going to be trying to earn, at least 1% or 2% in a US Treasury bond. But it has to be very short term and it has to be extremely liquid, right? There are rules about what you can still call cash on your income statement. And so those rules also state that the value of the excess cash and marketable securities must be marked to market on the balance sheet. So every time they update their financial statements, they must update the value of their marketable securities. So the price of whatever treasury bond they had actually changes quarter to quarter. They need to go look at the new price, multiply that by the number of bonds that they have, and give us the new value, whether that's less or more. Okay? So marking to market can sometimes be a negative thing for firms and can drastically reduce the value of their balance sheet when times are bad, like they are right now. Right? Any firm that had stock outstanding during this current crisis, when we see their quarterly statements come out, they will have marked that down to the current market value, and the value of their assets is going to be significantly less. Because they estimate the market value themselves, if we have excess cash or marketable securities on the balance sheet, or equity holdings on the balance sheet, we can use the most recent book value as a proxy for their market value. So we don't have to do any work. We just go to find the last current historical book value for the asset, and we add that to our value of operations. That's the value of cash and marketable securities at that time. That's why part of why we don't predict these changing over time, right? We don't predict excess cash changing. We do use it as a plug, right? But we don't predict equity changing, right? Because we don't want to get into that. We're just going to use the market value, the most recent market value, and that is the most recent book value because they have to be. Non-consolidated subsidiaries and any other equity investments, these are things where companies, we own a non-controlling stake in another firm, and because we don't have any formal control, if this stake is low enough, we don't have a majority control, financial control, we don't consolidate their financial statements. So they file separate financial statements from us, and we both just report. They report that we have a stake in them. We report that we have a stake in them. They pay us dividends because we own a piece of their firm, so we get a claim on their profit, and we report that investment income on the income statement, and we report the equity holdings on the balance sheet. Right? Now, again, when we calculated NOPLAT and invested capital, we did not include either of those items because they're not involved with the firm's operations. So we value them here with the rest of the non-operating assets, and this can be easy or it can be hard. It can be easy if the subsidiary is publicly traded. Then we can look at the market value of the firm because we can see the value of their shares on the open market, and we can estimate the value of our stake. If it's privately held, if it's a private company and we can't see what their prices are, what their value is, then we've got a lot more assumptions to make, a lot harder process. Okay? Then customer financing arms, again, this is a financial subsidiary that's almost entirely based on the fact that some companies sell products that are so expensive you can't buy them without a loan. And so the companies recognize that, and they formed a company, a small bank, that is entirely just a customer financing arm. Just loans money to people to buy the product. And these are typically consolidated, which means we have to unconsolidate them because we don't want to commingle a financing company with an operating company because the way we value them are totally different. Okay? And we'll talk a little bit about that. We'll look at a small example here. Basically, if they have a financing arm, we have to consider this as a separate company, and we have to do a DCF-like model on the subsidiary itself, and then add the value of that company's operations to our own company's operations. Okay, so if they have a financing arm, your job got a lot harder and more complicated. But this is a pretty common thing. The big car companies, the big airline companies, for a while, GE had one of the biggest banks by assets in the world, and it was entirely a financing arm. They sold credit cards and other of their products on credit. So it's pretty common, but it does make your life a lot harder as an analyst. Okay. So these are the most common ones. We'll talk a little bit about non-consolidated subsidiaries here. Again, this can be easy or it can be hard. If it's easy because the subsidiary is also a public company. And so we can observe their prices trading in a public market just like our own prices. And then I can say, okay, if I own 10% of that company, then I can easily estimate 10% of that company's market value and that's the value of my stake. And then that's what I go and plug in that number as the value of that non-operating asset. Right? If it is not publicly traded, right, and there are lots of publicly traded subsidiaries. Remember, some really big companies are owned by even bigger ones. For instance, eBay used to own PayPal. eBay used to own StubHub, right? You have GE and GM and Ford all have really big major public subsidiaries. Amazon owns all kinds of different public firms. So sometimes it's easy on us and we can just record the value of the stake in that way. If it's not, if the subsidiary is privately held, meaning they don't have public shares, then we can't just look at their share price and estimate their value because they don't have one. What we have to do is look at their financial statements, value them on our own, again, making our life more complicated. We have to do a DCF valuation on a privately held company, which is hard because we may not have their financial statements if they're privately held. Depending on who and where we are, we may have access to them, so we can do our own DCF. We do our own DCF, then we say, okay, we own 10% of this value, of that company's enterprise value, and that's the value of our non-consolidated subsidiary. Finally, if we don't have any of that, we can use a couple of different ways. The way that most people are going to do is just a simple multiples valuation, and we were going to have a chapter on multiples. We had to cut it for time reasons, but multiples is a sort of common back-of-the-envelope valuation method, or what's called a tracking portfolio. And basically, we're just going to do our best because anything that we do is not going to be a very good job at that point.